Good morning, everyone. It's now 10 a.m. It's fantastic to have you all join us this morning for this early or mid-June Sterling Private Wealth webinar. My name is Graydon Morris, Managing Director of Sterling Private Wealth, and I'd like to extend a very warm welcome to you all. We expect our speakers today to be very insightful and educational for you, and I'm sure they have much to say, especially given the very volatile and ever-changing world we find ourselves in. We shall begin this morning with Ray Shapiro, the Chief Investment Officer of our sister company, Merchant West Investments. Ray has been with Merchant West Investments for over 10 years. I still remember interviewing at an office just down the road from where we are now in those early days of the company's existence. Ray has had a stellar academic career and ran global money for Melville Douglas in his earlier life before joining Merchant West. He is a great asset to the investment team, is supremely knowledgeable, and is passionate about all things investing. Ray truly is the closest you will get to a walking investment encyclopedia. Apart from his CIO role, Ray is intensely focused on the local dividend equity fund and the global equity fund. The global equity fund is a top peer group performer since Ray took the fund over around 5 years ago. As a result, it has now been on the shopping list of many DFMs and fund selectors of late. Ray will discuss a few global macro factors affecting market pricing and dynamics. Following on from Ray, we shall hear from Dan Brocklebank of Orbis. Dan's CV and his bio was provided along with the webinar invitation, so I won't go into that in too much detail, other than to say you're going to be hearing from a top quality investment professional who's part of a very successful long-term team. We have partnered with Orbis and Allan Gray since we opened our doors to business in 2002. It has been a highly successful partnership for our clients. Orbis's track record dates back to 1990, and the outcomes for clients in the Global Equity Fund and the Global Balanced Fund that was launched later, and their respective feeder funds, of course, have been very favorable. Orbis's disciplined and valuation-orientated approach resonates very well with us at Sterling, and the investment outcomes speak to that. These two aforementioned funds are large holdings in many clients' portfolios, and we are very thankful for that. Without any further delay then from me, over to you, Ray, firstly, and then, of course, Dan thereafter. We hope you all enjoy these presentations.
Thank you, Graydon, for those very kind words. I do indeed remember our first meeting those 10 years ago. It feels like a short time ago, but at the same time, quite a long time ago. A lot has happened in markets. Thank you, everyone, for taking the time to join us. My presentation is going to be short, sharp, and to the point. Don't be too concerned about having to focus for too long. I'm going to just touch on a few key points that have been driving markets. Just bear with me while the slides load up. So I would say so far it's been a very exciting year. I know in the investment world we always tend to use these kind of superlatives, but I think this year has been especially tricky. I actually used ChatGPT to make this little graphic here. Fantastic stuff. I mean, tells you about all the drivers, both in South Africa and globally, in one slide. So there's a lot of fun there. I think the term that encapsulates it, what we've experienced so far is everything all at once. Top of everyone's mind, I think, are tariffs. It seems like every single day some new news comes out that causes some kind of volatility or some kind of confusion, obviously coming out of the Trump administration mostly. This is really the OECD forecasts for real GDP growth, and we can see already in May they have lowered their GDP forecast from 3 and over 3% down to 2.6% in these kind of uncertain tariff times. Interestingly, if we actually just move on to the next slide, and what this is these are the market moves in 2025 year to date, all in US dollars. And we can see that the market already has somewhat digested a lot of the tariff uncertainty. And the one point I'd like to make here is these returns are certainly not, I think, what anyone would have predicted at the beginning of the year. Firstly, the all share index is in fact up 22% this year in dollars. That's compared to the S&P 500, which is only up 2% in dollars. A lot of the all shares movement is in fact has been driven by gold shares, which up 100% in dollars year to date. So that is a huge move. Gold shares now comprise close to 15% of the all share index on their own. The MSCI China is up 16%. The MSCI World, excluding the US, is up 16%. That is mostly Europe with a bit of Japan. And we can see one of the drivers of this, in fact, has been the dollar index. So it's a trade weighted dollar, which has weakened 9% just this year. So that is, of course, fueling some of the rises in the other indices, but it's not explaining everything. And as I said, the S&P 500 up only 2% this year. This is, of course, in stark contrast to what we've seen over the last 10 odd years. One of the drivers of this, I mean, there have, of course, been many drivers. We know tariff and the Trump administration and the uncertainty injected there has been one of the drivers. But I think the valuations of the US markets represented by the S&P 500 versus the MSCI World, excluding the US, we've reached quite wide levels. In fact, the world, excluding the US, is pretty close to its 15-year average. This is on a price earnings ratio. But the answer is other valuation ratios give similar results. Where we can see the S&P 500 is sitting well above its long-term average on just about any measure, I might just add. And in fact, the growth rates being forecasted by Wall Street and the City and other forecasters, in fact, not very different in terms of earnings growth. It's kind of 7% for the rest of the world and 8% of the US. So it's tricky to see how a lot of this difference in valuation is justified. And we would caution investors to really look at the stock level and interrogate each stock. But as a whole, the US market does look pricey. I want to just change tack a bit and focus on a drawdown lesson. Probably about a month ago now or so, we had a very steep drawdown. Graydon and myself did a little webinar just talking about the drawdown, how to handle it, and what history says. And I just want to circle back and follow up on what actually happened. Lots of investment people, of course, make predictions and say things, but there's not always follow up. So I think it would be useful to follow up on that drawdown that now seems like a bit of a distant memory, even though it wasn't that long ago. We had a 19% drop in the S&P 500 in April. That was the drawdown of its maximum, although it didn't take very long. And as we can see, it was a very short and sharp drop, and it seemed pretty scary at the time, didn't it? As we also said at the time, and this is a bit of a recap, drawdowns are in fact to be expected. And we can see here that the latest drawdown at the end there, it doesn't look particularly large in the context of history. And, we've gone back over 50 years. In fact, the average fall in any 1 year maximum drawdown, so a peak to trough in any rolling 12 months period is in fact close to 14%. We had 19. So what happened post that fall? Well, as it turns out, Sterling and Graydon were obviously very good at bottom ticking markets. In fact, when we did the presentation on it. In April, it got quite a few views subsequently on YouTube. In fact, one of our analysts, our head of research, Alyssa, posted it on LinkedIn, and it got something like 200,000 reposts and thousands of comments, all and mostly naysaying, saying, well, you haven't seen nothing yet. The market's down 17%. It's going to get a lot worse. Well, As it turned out, the market fell just another 2% to be down 19%, and then subsequently has proceeded to rebound 20% to leave the S&P 500 marginally positive for the year. The point is, had one panicked, even just a little bit, even selling 20, 30% of one's holding at the bottom, at the 17 or 19%, one can do a lot of damage to your long-term returns by selling at the bottom. And we can see subsequently what happened is the market rebounded 20%. In fact, at the time, the work that we did based on history was that in any fall 17% or more in the S&P 500, the probability of a double-digit return in the following 12 months is in fact 85%. So you've got an 85% chance of earning a double-digit return following a steep drawdown in the market. And this is exactly what's happened. We in fact already have a 20% return. So what is the lesson? The lesson is do not panic when everyone else is panicking. Circling back to US markets, which have been pretty soggy year to date, up only 2%. What do we think is really weighing on US markets? And we can see here there are a few sectors that are weighing particularly heavy on US markets. The one is the Magnificent Seven, made up of Meta, Microsoft, Nvidia, Amazon, Alphabet, Apple, and Tesla. Other things that are weighing, in fact, on the S&P 500 are healthcare stocks, largely thanks to RFK Jr. teaming up with Donald Trump and threatening a lot of policy changes, especially to control drug prices, and then energy with the weakish oil price. And of course, Trump talking about drill, baby, drill also introduces some uncertainty. But as a whole, oil prices globally have been soggy. The point I'd like to make here is, however, especially with regards to the Mag 7, is I feel it's quite dangerous to lump all these stocks together into one kind of name, because we can see year to date there's quite a big dispersion in returns for the Mag 7. So we can see year to date, Meta is in fact up 19%, Microsoft is up 12%, Nvidia is up 6%. However, Tesla and Apple are both down more than 20%. So it's very dangerous to lump this grouping of stocks into one bucket. And we would urge anyone to consider them as individual stocks and evaluate them on a bottom-up basis. What we do know is that we've had a not insignificant derating of these stocks as a group. Just before that drop, they were trading at well into the 30 times earnings. Now they're sitting at about 30 times, and this is a significant premium to the market. The US market is sitting at approximately 21 times forward earnings, whereas the Mag 7 is sitting at close to 30 times. So is this derating of a lot of these stocks justified? We can see historically, going back to 2015, so for the last 10 years, as a group, these stocks have actually grown at 35% per annum. All of them have been, in fact, very strong growers. And going forward, the market is only forecasting 14% growth. And one of the reasons I think we had a derating of these stocks, besides the news about the Chinese startup DeepSeek, was the market started to digest the growth in the future may not be as strong as the growth in the past. So the growth that was forecast to decelerate. However, what we're seeing here is there's quite a bit of forecast risk in these companies. So for instance, what's happened, this is Q1 results. So it's March this year's results. The Magnificent Seven have in fact grown at 32% in the first quarter. And that is a 14% beat on consensus. So the market was expecting, 14 to 16%. But what's been delivered in the first quarter is 32%. So that is a massive upward surprise, and that is what's driving a lot of the re-rating off the lows. I think what we have to take out of this is there is high forecast risk. The market does not know what the growth rate is going to be in the Magnificent Seven. And that's why we have to approach it with caution, because often higher growth rates cannot be maintained indefinitely. Out of interest, the S&P 500, excluding the Mag 7, is ticked along at 7%, which is almost exactly in line with what the street has been forecasting. So the market has some idea of what the rest of the companies outside of the Mag 7 are going to do, but has absolutely no idea what the Magnificent Seven is going to do. So I would caution high forecast risk. There is both upside and downside risk. A point I'd like to make, however, that I think the market is only slowly coming to appreciate is that artificial intelligence, and of course the Magnificent Seven really do encapsulate a lot of the trend around artificial intelligence, is that AI is very hungry from an energy perspective, and it's getting hungrier. In fact, already data centers, which are already powering AI, are consuming more electricity than the entire country of France. And by 2030, they are forecast to be basically the fourth largest energy consumer in the world, far more than France, Germany, Canada, Brazil, or Japan. So all these chat GPT queries that we may be doing, or all this AI, all these AI little experiments that we're doing, are actually consuming an enormous amount of electricity. Interestingly, that EVs are so pretty high up the scale, but the growth rate is looking to be huge over the next 10 years and more. What I found interesting was this chart is that the United States has 10 times the data center of any other, 10 times the amount of data centers of any other country. It's got 10 times the number two ranked, which is Germany. And in fact, China would have expected it to be a little bit higher up the scale, but the US has far more. And I think this does, one, consume a lot more electricity relatively versus any other country. But what it also shows is that the US, I think, is unlikely to lose tech leadership anytime soon. With other countries not building as many data centers, it's hard to see the US losing its tech leadership status anytime soon, despite what you might see in the headlines. This is a fascinating chart that one of our analysts put up while analyzing energy stocks very recently, and that is the forecast of US data center energy consumption as a percentage of total electricity demand. So we can see already data centers are consuming 5% of all electricity in the United States. By 2030, that is forecast to double to 11.7%. So, I mean, we're doubling in less than 5 years. So that is a pretty strong compound annual growth rate, well into the 20% per annum growth rates. However, this is the electricity supply, the forecast electricity supply from the US EIA. And we can see there's actually no forecast increase in electricity supply in the US, which is crazy considering that the electricity demand of data centers is ramping up very strongly. Interestingly, we can see natural gas is at least 40%. Supplies at least 40% of US electricity. And what I find fascinating is how big renewables are already in the US in terms of electricity generation, as well as nuclear. So natural gas, the dark blue, renewable sources of that light blue, and then nuclear power is the orange color. So we can see the issue is there's no increase in electricity supply, and most of the major oil companies of the world, they also supply a natural gas. So where is this supply growth going to come from? I think it might be time to consider energy. We've seen how energy stocks have in fact been weak year to date, and have been weak for a little bit longer than that, in fact. And we can see how the weight of energy in the S&P 500 has gone from 8% 10 years ago to only 3% now. In the depths of COVID, when the oil price dropped to ridiculously low levels, the energy weight was 2%, and now we're only at 3%. If one goes back further, energy as a weight of the S&P has gotten as high as 20%, and in fact over 20% of the S&P 500. We are currently sitting at 3%. I think the point is that there's a lot more energy is going to need to be provided. A lot of that energy I think is going to come in the form of natural gas. Renewables should grow strongly as well as should nuclear, but natural gas, especially in the United States, where it is plentiful, should grow strongly, and there should be the demand should grow strongly, but the supply isn't growing as strongly. And if one looks at a lot of the expansion plans of the big oil majors in the world, there aren't many expansion plans. In fact, they are at all-time low levels of investing in terms of capital expenditures. So the big oil majors are near to all-time lows in terms of investing in increasing their capacity. So something's got to give. We could see a spike in energy prices, and it could very well be fueled by the demand for AI. So those are two things a short time ago one wouldn't have put together, the fact that AI could fuel energy prices and the demand for energy. So that's just something to think about. And with that, I will say thank you very much and hand over to Dan.
So good morning, Ray, and everyone on the call. Thank you very much for those comments, and thank you very much for the introductions. I'm assuming you can hear me okay. Graydon, thank you very much for that introduction. It was interesting to note that your partnership with Orbis began in 2002. Coincidentally, that was actually the year I joined Orbis. So I've been with the firm for 23 years now. I'm just going to bring up my slides, and hopefully that will enable you all to see the front. There we go. I hope that's coming through. Before I kick off, I just thought I'd give a bit of context into this presentation. Because strangely enough, the idea behind this, or the story behind this presentation, which is a little bit different from Ray's, but it actually started with the Argus, which is a bike race I'm sure many of you are familiar with in South Africa. Last year, I was asked or invited by our colleagues at Allan Gray to come down and speak on a panel at a conference. And that was the Investment Forum conference. And it's a big one that's held in Cape Town one week and then Johannesburg the following week. Found myself on a Friday evening in Cape Town as a very keen cyclist, discovering that one of my bucket list races, the Argus, was actually happening on a Sunday, and I'd only realized it when I got down there on the Friday evening. I scrambled trying to find a place and a bike, but wasn't able to do it, and so I suffered torture over the next sort of 36, 48 hours as Cape Town was overtaken by cyclists. I was literally having to, people were bringing bicycles in the lift in my hotel as I went into my room, which was very painful because I had been wanting to do the Argus for a long time. Anyway, I got back, and the debrief back in Orbis in London, I said, look, I think it went okay, but if we need to go to that conference again, I don't like to do this, but I'm pulling rank, and I'm going to go and do that because I've got unfinished business down with the Argus. Anyway, but a few months later, somebody tapped me on the shoulder and said, yep, they want us back and you can do it. And there was this pause and said, but it's not a panel at the conference this year. I said, oh, okay, what's up? So they want a presentation. I said, okay, that's fine. So, but the brief for the presentation is a little bit different. The brief is that it's got to be thought-provoking, it's got to be about markets, and it can't be anything to do with Orbis at all. So I looked at them and I thought, crikey. So I basically got to write something equivalent to a TED talk. And the lady nodded and said, yep, that's right. So in fact, January in this year, I found myself with a blank canvas. I don't think you can be the judge whether it's worthy of a TED talk at all, but I found myself with a blank canvas trying to come up with some thought-provoking thoughts about markets at a time when, of course, everything was starting to change. About a year ago at Orbis, we were talking about how markets were going through what we described as a super cycle. In fact, that cycle had become so extended that we were calling it the great misallocation because of the bubbles and the distortions that it was created, that were being created in the market. But as I sat down with that blank canvas, trying to think about how to be thought-provoking about markets, obviously things changed a little bit, and this came along. And while it may seem chaotic and surprising, and it's great to hear that the Sterling team were able to keep a cool head through the downturn, I would actually argue that some form of new environment was inevitable. because the skews that have been building up inside the market were very, a little bit like a bubble waiting to be burst from a valuation perspective. And I'll leave it to you to insert your own joke at this point about bubbles and pricks. But today, the volatility that we're seeing, and we have seen this year in the market, I would argue is not the problem. It's actually the symptom. And today I want to build on that idea, because I think the real challenge that we face as investors in markets today are the unresolved balances that remain, and imbalances that remain. And we as investors are going to have to navigate those over the coming years. So I hope in the next 25 minutes or so, I'm going to be able to give you a few lessons or thought-provoking ideas to help you navigate all of that uncertainty. But I want to start to do that. I want to start in a very different place, because I want to introduce you to a hero of mine. And to get there, I want to start by asking a question. If you can bring up the first question, please. The question is a simple one. In IQ tests, can you guess as to what the highest ever recorded score was in an IQ test? And just to put that in context, the IQ tests are calibrated such that the average is 100. And if you can score over 145, then you're described as being especially gifted. So the question for all of you out there today is, what's the highest score ever recorded in an IQ test? Just have a guess, have a bit of fun. I think it's all anonymous as well, so there's no naming and shaming here. Okay, I don't think I can see any results coming through. I don't know if they're coming through, but maybe you could give me a feel for what sort of range we're getting. Anyone? Maybe the questions aren't working. I can't see the answers. I'll have a quick look in the notes. I'll have a look in the chat. Maybe that's where they're popping up. Oh, we've had a few answers. Okay. Well, the highest guess I've ever had from an audience was 215. But the actual answer, I don't know if anyone got close today. I can't see all of the answers today. The actual answers, according to the Guinness Book of World Records, the actual answer, the highest ever recorded IQ test, was 228. Now, that record stood for nearly 5 years in the late 1980s. And the holder of that was a lady called Marilyn Vos Savant. And Marilyn Vos Savant, as you can probably imagine, off the back of that, became quite famous. And one of the things she ended up doing with her celebrity was she ended up writing a column for the American magazine called Parade. And every week in that column, she would answer a difficult question that had been sent in by readers. Now, that column even celebrated its 30th anniversary back in 2016. But it was back in 1990 that she sparked the controversy for which she is most famous, because a reader wrote in with a question that went on to become famous as the Monty Hall problem. Now, why was it called the Monty Hall problem? Well, it was loosely based on a game show from the 1970s and 1980s that had been hosted by Monty Hall. But the question the reader sent in went like this. Imagine you're a contestant on a game show and you're shown 3 doors. Behind one of the doors is a car, and behind the other 2 doors are goats. Now, just to clear one thing up, this is not some sort of ESG presentation. So can we all just assume that the contestant in this game show would rather win the car and not the goats? If you don't do that, everything's going to go a little bit wrong. Now, the prizes are obviously shuffled behind the doors, so the contestant doesn't know where they are. And the game starts with the contestant choosing a door. In this case, let's assume door number 1. Once the contestant has done that, the host goes to one of the other doors and opens it to reveal a goat. Now, ordinarily on a TV show, you would think this is just a normal step by the host to build a little bit of tension, and the next step is that the host would reveal what the contestant has won. Here's the twist. In the Monty Hall problem, instead, the host gives the contestant a second choice at this stage. And that second choice is, would the contestant like to stick with their original choice, or would they switch to the second unchosen door? With 2 doors remaining and 1 car left to win, can it ever make sense to switch? Surely it's just a 50-50, or is there something weird going on? Now, I'm going to try a little bit of audience participation again. I'm not sure if it'll work, but normally what I do is ask people to put a show of hands. Would you stick and here's the second question, if we can bring that up. How many of you would stick with the original choice? And how many of you would switch? Okay, let's just vote quickly if you can. I'll give people 10, 15 seconds just to put a vote in there. And if you could close, and can we see the answers? See if this works. I can't see the answers. I don't know if anyone can see it out there. Let's have a look in the chat. So we've got 38%, 38 stickers, and I don't know how many have switched. Oh, okay, here we go. Perfect, thank you. 3/4 of you, 76% have voted to stick, but 24% have voted to switch. Well, okay, firstly, at this point in time, I think I owe you an apology. If that question and that thought has brought back unwelcome memories of maths lessons and probabilities, then I do apologize. I also have a small confession at this stage. As a teenager, I became mildly obsessed with this problem, and it wasn't just because Marilyn Vos Savant was involved. But back in the day, I actually took one of these, which is a Commodore 64, and I used it to write a program in the basic programming language to simulate a few thousand rounds of that question I've just posed to you to try and test the answer. And just in case any of you are wondering, do want to make it clear that that picture was not taken in my bedroom back then of my actual computer. Anyway, before I reveal the solution, some of you are probably wondering, what on earth am I doing talking about Monty Hall, Marilyn Vos Savant, and goats? So I should probably explain why all this is relevant. Well, back in January, faced with that blank canvas, I rediscovered and re-remembered the story. And it struck me that the solution to and the story behind the Monty Hall problem actually contain a number of valuable lessons for investors today. And those 3 lessons are as follows. The first is that what's obvious is not necessarily right. Our brains can trick us. For example, we know from studying behavioral finance that they can mislead us by oversimplifying. Human knowledge also evolves over time. So just as importantly, many ideas that seem obvious now, at some point in time, were once considered radical or counterintuitive. The second lesson is that to be successful at anything, but particularly in investing, you need some real insight or some sort of edge as fuel. And the third lesson is an uncomfortable one, I'm afraid, because as humans, we all crave certainty to varying degrees. But the third lesson is that nothing in life is ever certain. The future is far more uncertain than we realize. As a result, we need to be humble. You can have the best process in the whole world, unfortunately, still get a bad outcome. And the really important lesson for investors is that in life, but particularly in investing, it's critical to think about resiliency and whether or not you can survive the full range of outcomes that may occur rather than just the most likely outcome. Okay, let's dive into each of those lessons now. And I want to go into number 1 by picking up where we left off with the Monty Hall problem. Now, 3/4 of you voted, as I initially did, to stick. But I'm afraid to say we were all wrong. And that Marilyn Vos Savant in September 1990 in her column correctly argued that faced with that particular choice, contestants, if they want to maximize the chance of winning the car, should always switch their choice. So well done to the 24% of you who got that right. Now, I suspect a few of you out there are scratching your heads today and saying, no, that can't be true. Here's how you have to think about it. Let's go all the way back to the start and assume again our contestant chooses door number 1. It's clear at this stage, I think we can all agree that contestant has a 1 in 3 chance of selecting the car at that point. And similarly, each of the other 2 doors have a 1 in 3 chance of containing the car. Now, if we combine that, we can say that there's a 2/3 chance of the car being behind the unchosen doors, the orange doors in this image. Now, the host always opens an orange door and always reveals a goat. What's key to realize about this move is that opening door number 3 doesn't change the probabilities that we've just agreed on. Opening door number 3 also doesn't move the car. There's no trickery going on here. But what it does do is eliminate one of the orange doors. We know that the probability of door number 1 being correct was 1 in 3. There's only 1 door remaining in that orange zone. So the chance of it being behind that door must be 2/3. Therefore, to maximize the probability, it's always going to make more sense to switch to door number 2. Now, if your brain is fighting this, don't worry, that's perfectly natural. You're not alone. That is what sparked my obsession with this question all those years ago. When Vos Savant published her answer in Parade magazine, it sparked serious controversy, by the way. How could this 50-50 opportunity set have such a skewed probability? Parade magazine even received 10,000 letters from readers arguing that her response was wrong. Of those, 1,000 of them came from people claiming to have a PhD in maths. Unfortunately, many of them were also hostile and blatantly misogynistic. Now, if you're still not convinced about that answer, this alternative explanation can sometimes make it more intuitive for people, at least to see why switching makes sense. Instead of using a version of the game that has just 3 doors, well, the way to see it is to imagine a game that has many, many more doors. I wanted to go out to 100 doors or even 1,000 doors, but the person helping me with the presentation at this stage threatened to resign. So we settled on a version of the game with 50 doors. So imagine you're playing this game today and you pick a door. Let's just assume it's the top left. We can all agree that you have a 2% chance or 1 in 50 of being correct first time round. There's a 49/50ths or 98% chance that the car is behind one of the other doors. Now, importantly, in this game, the host doesn't just open one of the other unchosen doors. He opens 48 of them, leaving 1 door remaining. Now, in this case, do you really want to bet that your initial choice was right? Or do you think it's going to be more sensible to change door to the one the host has left open? The brutal reality of the maths in this version of the game is that you have a 98% chance of winning if you switch at that point. Ladies and gentlemen, the solution to the Monty Hall problem is a great example of a situation in which the obvious answer is not necessarily right. But you've got to remember the flip side of this too. Many ideas that we know that are obvious now were once considered radical or counterintuitive. Coincidentally, just as Vos Savant was unraveling the Monty Hall problem for her readers and the maths world, a bubble that is now recognized as obvious in the stock market was starting to unravel. Today, it's obvious that having Japan's weighting at over 40% of the world index in 1990 was crazy, but that didn't stop it happening and then unraveling. Similarly, 25 years ago, almost to the month, another cycle in the stock market that's now acknowledged as an obvious bubble started to burst. Technology, media, and telecom stocks had soared in popularity in the late 1990s on the belief that the internet was going to change the world, when the weighting went from over 40% to much lower over the decades. Of course, people were right. The internet was going to change the world, but the market got too excited, and we all know what happened. So what do we make of all of this? Well, Monty Hall and the history of markets show us that accepted wisdom can turn out to be very wrong over time. So the first thing I think we need to do as investors is to be aware of what the market is treating as obvious at the moment, what the market is, or what we refer to as what is consensus in the market. But as contrarians at Orbis and Alan Gray, we would actually argue that when it comes to investing, you have to go one step further. And it actually pays to beware of the consensus. Investing is not like bridge building. If 9 engineers tell you to build a bridge in a certain way in a certain place, and there's one lone wolf telling you to do it differently, we all agree you want to go with the consensus view. If 9 people tell you a stock's a buy, but one person raises some different concerns, chances are you want to listen to them. So what is driving consensus today? There are many, but I'm going to argue there are 2 strong mega bets today. The first is pretty obvious and is brilliantly captured by this meme. I don't know if any of you remember that can recognize the film that this is taken from. It's a brilliant meme. This is the 2025 version of The Wolf of Wall Street. Here is Jordan Belfort teaching his proteges how to hustle. And this is the 2025 version. It's AI powered. Every company out there today is trying to persuade investors that their company is AI powered. Some of them inevitably are, many of them are not. But the reason they're doing that is because they think they can get a higher valuation if the market believes that their company is somehow linked to AI. So there is one strong source of consensus today. Second one is probably the biggest one, and if I could only pick one, it would be this. Until perhaps earlier this year, there has been an overwhelming belief in US economic exceptionalism, both as an economy and as a place to invest. Now, clearly, Liberation Day put some cracks in that narrative, and in fact, the DeepSeek news that came out before that was arguably more important. But as Ray showed well, markets have rebounded substantially since then. Nevertheless, that view about US economic exceptionalism remains pervasive. Now, part of the reason for that, I should say, is that US companies have seen great profit growth, undoubtedly. But that profit growth cannot justify all of the increase in valuation, as you can see in a minute. Instead, I think what's been happening over the last few years is as simple as the old adage that price leads narrative in market. You would hope that narrative leads price, but often it's the opposite is the case. What do I mean by that? Well, take a look at this chart. This shows the US weighting in the world index. And here I've used the MSCI World Index, but you get a similar picture in any of the big world indices. Since 2011, the US weighting has grown from less than 50% to over 70%. That's pretty breathtaking. US equities now also make up over 40% of the passive 60-40 index as well. So I think it could well just be a case of the US having grown a bit and that strength being reflected in the narrative. There is a really key point to understand, though, about my view, what I'm saying here about being aware of the consensus, because the US economy has been a powerhouse. AI is also real. It's fantastic. I'm an advocate about it so much that my kids are taking the mickey about my new best friend being ChatGPT. But the risk as investors is that the market might be pricing in both of those beliefs as if they are obvious and as if the winners can be known with certainty, despite the fundamental uncertainties involved in all of in the macroeconomy and the market's long history of excesses and bubbles. There's been this enormous complacency develop about the performance of and safety of US-based assets, and that's starting to be challenged. So what could it look like? Well, if you look back in history, if you zoom out a little bit, I think this perspective is very valuable. In this chart, I've gone back 40 years, and the way to interpret this is that where the line is above the x-axis, the US market is outperforming the rest of the world. So what you can see is over the last 10 years, the US is solidly above that line is solidly above the x-axis. And as we know, the US market has been significantly outperforming. A whole generation has grown up used to this outperformance, forgetting that periods like this can also happen. History suggests that these cycles are decades long. Note that I'm plotting 10-year annualized relative returns here. And what's really important to remember is that the US is over 70% of the world index. So if you own a tracker fund or anything close to, or a not very active global fund, you have a large percentage of your portfolio in a market where valuations are high, and the pendulum of history would suggest that there can be significant periods of underperformance. Yeah, another outcome or a side effect of all of this strength in the US is that the market today is horribly, if not dangerously, concentrated. Now, you can measure concentration a few different ways. The way I'm doing it today, I won't go into, but the long-term average has been 6% on this metric. And you can see when we had the Japan bubble in stock markets, concentration spiked above that before normalizing. In the TMT bubble, you saw the same thing. Concentration spiked before settling down again. To show where we are today in terms of market concentration, I actually have to adjust the y-axis downwards to fit it all on. Today, 10 companies make up over 25% of the index. At Orbis, fundamentally, we believe that investors simply have to be wary when there is a strong consensus in any market, particularly when it's causing a strong concentration. Over the long term, it typically pays to be very wary of areas of the market where there's lots of excitement and glamour, and to look into less popular areas. It's also worth noting, as you can see from those cycles, is that adjustments can take many, many years to play out. Okay, that's lesson number one. Pays to be beware of the consensus. Let's look at number two, that success typically requires some sort of edge or insight. Going back to the Monty Hall problem, at this stage, most people, including most people on the call today, saw the answer as that. It's 50-50, 2 doors, 1 car, 50-50, can't possibly make any sense to switch. What was it that enabled Marilyn Vos Savant to realize that this was wrong and that the odds, in fact, looked like this? Well, what she realized was that at this point, at the point that Monty Hall opens one of the unchosen doors to reveal a goat, the host is not resetting the probabilities, but it is instead providing valuable additional information that the contestant didn't have at the start of the game. With that move by the host, the contestant is learning that one of the unchosen doors is definitely not worth picking. It's perfectly possible that the car is behind door number 1, but a losing option has just been removed from the 2/3 choice zone. The core lesson I think we should all take from this is that when dealing with uncertain outcomes like investing, it can really pay to stay alert for new information which can come along and provide insight, because sometimes it can materially increase your chances of success and improve your decision making. So the lesson from number 2, or what we can do about number 2, is that a key part of what investors need to do is to filter out all of the noise out of there, sift through the data to identify what actually matters and what is relevant information. In other words, what statistics geeks call signal. Now today, suddenly everyone's an expert on tariffs. I'm not going to go into that. Very briefly, I'm going to explore 3 potential signals that we are seeing that we think may be widely overlooked. The first of those is the sheer scale of speculative activity going on. I've heard about people investing on the basis of YOLO, or you only live once, from various angles. So I did a few bits of digging recently, and I even discovered this. These are the YOLO scouts exploring new crypto frontiers. They even have a mission statement, which is to embrace the laugh track to wealth. Now, it's pretty amazing thing. I think this is probably a front for North Korea. I'm not joking there. But when I found this sort of speculative activity going on, I thought it must all be, I hoped it all must be pretty marginal. So I did a little bit of work to try and put it in context. Those of you who are old enough to remember the last tech bubble, this company is now seen as the poster child of the hubris back at the peak of that bubble. Pets.com was advertising at the Super Bowl in 1999, despite the fact that it was selling all of its products at a loss. In the year 2000, it managed to sell its shares in an IPO in February and then go bust or bankrupt, had literally filed for bankruptcy in November of the same year, just 9 months later. The real mind bender to me, though, with Pets.com, looking at it from today's perspective, was its size. Because as its peak, it was only $312 million in total market value. Now, I say only, it's obviously a chunk of change, but let's put that in comparison to today. The center of the speculative activity going on today is cryptocurrencies and digital tokens. At the 31st of December last year, the total value of all of those was an astonishing $3.3 trillion. It's 1,000 times as much as Pets.com at the peak. That value was up 96% in 2024 alone. There are 17,260 digital currencies when I last checked. And while Bitcoin is the largest, and perhaps it is a useful one, maybe it is a useful one, but amongst all of the other ones is included a digital currency called, wait for it, Fartcoin. Now, I like to think of myself as a fairly open-minded chap. I do find it highly unlikely that my mother-in-law is ever going to be willing to pay for things in something denominated in Fartcoin. And yet that was launched in October of last year. The total value at 31st of December was just shy of $1 billion. And when I last checked earlier this week, it was $1.2 billion. That single digital token is worth today 3 times the size of Pets.com's peak valuation, a company that was the peak of hubris back in the last bubble. Now, it's tempting to think of all of this as a little bit of a joke and some harmless fun. But I think that's a little bit naive. It's clear that there is some deeply predatory behavior out there, and people are trying to use the classic pump and dump technology and psychology of luring people in with promises of easy riches and glamour, but with highly predatory motivations behind all of this. I don't envy the role the regulatory agencies have to stay on top of all of this stuff, because sadly, involvement in this goes all the way to the top. The reason I mention it, though, is that at $3.3 trillion, the size and scale of all of this is mind-boggling. I'm very willing to bet in future this will be seen as a problem that was obvious with the benefit of hindsight. And the reason I think it's relevant for everyone today is that if and when some or all of this gets dismantled, and I would argue it's a matter of when at least some of it gets dismantled, I think it's highly likely to cause some collateral damage to the economy or more mainstream markets. So I do think it's worth being aware of this risk on the sidelines. Signal number two, just to bring it back to equity markets, the second source of underappreciated signal today is really quite how strong US equity markets have been in recent years. This line shows the rolling 15-year annualized return of the S&P 500 going back 100 years. First thing you can see is that it's actually been quite variable over long periods of time. Over the last 15 years, US returns have averaged 13.8% per annum. Now that is highly, highly unusual. And I think the signal in here is that if you look back over history, previous periods with returns at this level have not provided a good setup for investors over the coming decade. Why does this matter? Well, firstly, it's 70% of the world index. Human psychology is that we tend to extrapolate from the most recent past. So it's easy to assume that this level of returns is normal. And that complacency is sucking people in from the sidelines, because as JP Morgan liked to point out, nothing so undermines your financial judgment as the sight of your neighbor getting rich. Or as I would say, FOMO is real. The catch, and Ray pointed this out in his earlier talk, which was great, the catch is that it's driven the US market to fundamentally different valuation points. The S&P today is trading at 23 times forward earnings. If we compare that to recent history, we can see it's only been as high when profits collapsed during COVID. These unusually strong returns that so many people have become used to originated from a period 10 years ago of fundamentally lower starting valuations. Returns for the next 10 to 15 years in the US have to be generated both from much higher starting valuations, but also from much higher size companies, because those magnificent 7 companies have grown to be absolutely enormous companies. Remember, this is 70% of the world index. And it's also important to recognize that this is not just due to the weighting of technology stocks. This chart compares Walmart's valuation to the world index. Walmart's a handy company to use because its business, selling groceries, has not really changed very much over the years. But you can see if you look back in previous bubbles, or in previous stock market cycles, I should say, Walmart itself has gone through phases of being relatively cheap to being relatively expensive compared to the world index. Likewise, over the last 10 years, we've seen it move from relatively cheap to relatively expensive. So it's not just tech stocks, US stocks, but particularly large and mega cap stocks are very richly valued relative to the rest of the world. The third source of signal I want to mention today is the potential evolution in some of the companies that have been the juggernauts behind the US stock market. I would completely agree with the point Ray made about not treating the Magnificent Seven as a common group. They're clearly very, very different, but we've got to give the headline writers scope to have a little bit of fun. What I want to do, though, is focus on 4 of them, all of whom are clearly great companies. They're clearly very valuable companies with strong balance sheets, but their economic value creation has historically come from supplying products and services at pretty close to zero marginal cost. And they've been able to do that globally very rapidly because they obviously provide their services over the internet. There is an important shift underway in their economics, and it shows up if you look at their capital intensity. The metric I'm going to show here is the capex to sales ratio for those big 4 companies. And the way to think about that is what percentage of their revenues do they need to invest each year in new capital equipment? You can see that in recent years, that line has inflected upwards sharply as a result of the arms race underway in AI. AI queries are much more expensive to provide than simple internet search. The capital intensity of their businesses is increasing, and this is not good news for investors. Now, it's impossible to tell when this will matter to investors, but these companies have become a large part of most portfolios today, or recently, and yet they are popular stocks that are already very, very big. Future growth that's embedded or required to justify their valuations is off a much higher base, and they have pretty high inbuilt growth expectations already due to those lofty valuations. The most important thing is that the economic characteristics of low marginal costs and low capital intensity appear to be eroding. Just repeat that. I don't know when this is going to matter. This may be sustainable for another 1, 3, 5, even 10 years, but it's something to be aware of, and it's something that we don't see talked about enough. Okay, filter out for signal. Let's move on to lesson number 3. Nothing is certain. Even if the contestant adopts the optimal strategy in the Monty Hall problem and switches their choice, they will still be wrong and fail to win the car 1/3 of the time. The odds, coincidentally, are roughly similar in investing. Even the best investors probably only have a 60% or so hit rate on their individual investments. And timing is always a problem. It took Marilyn Vos Savant 2 years of debate to bring all the skeptics round to agreeing that she was actually correct. Preparing for this, though, and I knew AI would come up in lots of different ways, I wondered whether in the brave new world of artificial intelligence, this uncertainty about the future might be different. So I thought I'd ask my new best friend, ChatGPT, if you're so clever, does it mean you can predict the future? So here is what ChatGPT had to say about that. Oh, totally. I've got a crystal ball, a magic wand, and a degree in fortune telling. But I'd rather not get sued when the future doesn't turn out exactly how I said it would. So let's just stick with the classic. AI is great at patterns, not so much at calling the lottery numbers. Now, that's a genuine response I got out of ChatGPT, but full disclosure, I did tell it to reply with British levels of wit and sarcasm, which I think it did pretty well at, actually. Anyway, folks, I think it's safe to say, or fair to say, sadly, that we are still on our own when it comes to dealing with uncertainty. But there is good news. As investors, we are not like the contestant in the Monty Hall problem. Unlike the contestant, as investors, we don't have to choose a single door. We have a superpower available to us, and that is the power of diversification. So the answer to this is to make sure that we have in place proper diversification, and that's what the good folks at Sterling, I'm sure, are helping you to achieve. I'm conscious of time, so I'm going to skim through these last bits. But here is basically a map of all the stocks in the world that shows their correlation. They're spread around all over the place, and the way to read this chart is that the closer any two dots are on the charts, the more correlated they are. You can see we've color-coded them regionally, and so you can see that just by going globally, you spread the dots around a little bit more, so you improve your diversification. But if I adjust the dots to show the weighting of each company in the world index today, a different picture emerges. You still have the dots all over the map, but there's a very significant concentration down in that left-hand area. This is what you're getting as a benchmark or near benchmark investor today. Unless you're running a properly active portfolio, chances are you're not properly diversified. You can see it also by looking at the number of stocks that are outperforming in the US. That's what it's averaged over time. That's how it's bounced around. Over the last couple of years, less than 30% of the stocks in the US actually outperformed. It's been a brilliant period to be a passive investor recently. A different way of showing or thinking, a more helpful way perhaps to think about investing and diversification just with this chart. There's a huge skew in the environment in this boat, like there is in markets today. The key to focus on in this chart is what the skipper is doing. Where is the skipper positioned? Of course, he's sitting on the opposite side of the sail in order to provide some counterbalance to the boat and at least partially offset the skew from the wind. That comes naturally to most people in boats, but not with investing, because we all have FOMO and want to be involved in the exciting parts of the market. So the good news is that outside the US, there is much better value on offer. We know that the US is re-rated upwards. The world ex-US looks like this. So you don't necessarily want to buy all of the world ex-US stocks, but it certainly offers a more attractive pond to go fishing in. And despite the declines in the dollar year to date, the dollar still remains very strong on a trade-weighted basis. So an added bonus of looking outside the US is that you can buy cheaper stocks in cheaper currencies. So that skew is what we are looking to deal with at Orbis. If we overlaid the global equity fund onto that, you would see that the blue dots are much more spread around. And we believe that with a fundamental bottom-up and contrarian perspective, we're able to find a portfolio where the blue dots are much more spread around and much more better diversified, but also are available at fundamentally lower valuations and with a much better margin of safety. So just to recap very briefly, I ran through 3 lessons and what we can take from them as investors. Perhaps the final point is that diversification really is the key to all of this and is the key to balancing that. And the good news is that you can use sailing as an analogy for that. I started out today saying that the story behind this presentation began with the Argus. I'm pleased to say that I did actually make it to the start line this year, and I even finished it. It's been an absolute pleasure. Thank you very much, and I hope that was thought-provoking for some, if not all of you.
Thank you, Dan. Yeah, thank you very much to both you and Ray for sharing your wisdom and insights with us. Yeah, much appreciated, and I'm sure it was very well received by our audience. We do have 1 or 2 questions that I think I would like to just raise. So obviously, both the two of you have spoken about the history of, or the narrative around US exceptionalism over the last number of years. And I guess, you know, the market performances in 2025 have obviously favored Europe and potentially emerging markets. But question for you potentially, Ray, are we seeing a shift away from US markets and potentially into European and emerging markets on a, say, consistent basis? And then I want to add to that, just particularly focusing on China. Now, I'd say the last, say, 2 or 3 years, I've seen a lot of Western investors concerned about transparency, you know, about governance. But, you know, do you see potentially a more permanent change in that mindset over the coming years? So I'll pose that to you, Ray, directly, but Dan, obviously, feel free, please, to add to the insight there.
Thanks, Graydon. Yeah, there are a few questions in there, and I think the point to make, obviously, we are using a lot of generalizations in this presentation, but I think it bears making the point that obviously we don't necessarily invest in entire countries. We invest in companies. We look at companies trading at discounts to their fair value. There's no doubt that the US has you know, a huge number of businesses, high quality businesses. The issue often that is cropping up, and I'm glad Dan used that Walmart example, where you've got a great business, but the valuation, it's just hard to make money at those valuations. The US is blessed with a lot of interesting companies with great prospects for growth. So I think it's important to realize that in terms of the actual money management, there's a lot of bottom-up investing going on. So I think that's an important point to make. So it's difficult to make these. I think neither of us are kind of ETF investors where we're buying country ETFs. So I'd like to stress the importance of bottom-up investing. I think in terms of China, yes, of course, the very difficult part there is the regulatory environment and the heavy-handedness of the government. The Chinese are not necessarily don't necessarily buy Pareto economics, the efficient allocation of resources. They have other goals in mind. However, a lot of the evaluations of a lot of stocks look attractive, especially relative to their growth prospects. Obviously, there are risks, and I think the way one controls those is by position sizing. I think going and putting 50% of your net worth into Chinese stocks isn't terribly wise, but one has to scale the position according to the risks, and they're not fully encapsulated simply in the valuation or the growth prospects. Did I answer all of those, Graydon? I think there might be another one in there.
No, thanks so much, Ray. I mean, Dan, unless you would like to add something, I'll.
No, not a huge amount to add there. We find that it's about having an edge. Where can you have an edge? It's very hard to claim you have an edge in the political analysis in China.
Sure. Just one further question. Ray, you particularly spoke obviously about the gold share rally in South Africa. Obviously, partly as a result, or maybe largely as a result of the movement in the gold spot price itself. This is a question that a lot of our clients are asking us. Obviously, given the rally in this area, is it over? Is it too late? Is there rationality in the price? Is it justified? And what is the mindset that potentially driving that behavior?
That is a very difficult question. I will make the point that over the long term, you're actually better off buying gold, physical gold, than gold equities. Gold equities obviously get over leveraged, and they tend to invest at the wrong time. So you make a better long term investment in the actual physical gold, or the ETF, something like that. I would just say, if you look at gold just on just about any measure, one of them is relative to the oil price. It's really pretty much almost at all-time highs. It looks very overvalued based on just about any measure. I think it's really reflective of the uncertainty. People are buying it as a kind of a hedge against disaster. I know people say it's an inflation hedge, but I really believe it's a hedge against maybe disaster or calamity. But there's also a lot of, I think, a lot is being driven by central bank purchases of, let's just say, non-Western governments who are nervous about mainly China and Russia, who are nervous about the US dollar holdings, and they need something else. And a lot of the gold price, I think, has been driven by that geopolitical risk and the actions of governments. And then, of course, there's the crowd, there's the consensus who just juice the whole thing up. So I see gold as quite overvalued at current levels. Calling it over the short term is close to impossible.
I would just pick up on the inflation protection side of that, because I think that for some people that is it's a protection against the debasement of fiat currencies, which is two sides of the same coin. Share many of those views. I think we are in our multi-asset funds, where we have to think about inflation, the fixed income side of things. We are very cautious about the prospect in fixed income, given the scale of the debt challenges at the sovereign level around the world and the imbalances around there. So we do own gold in the balance strategy, and we have varied over time that allocation between the physical and between the miners. But I think just probably more importantly, our fixed income exposure is almost entirely in assets where we feel very good about the inflation protection, either because it's direct, they are inflation protected fixed income instruments, or because they are in fundamental currencies that have very, very sound backing and very good government credit positions.
Thank you, Dan. And if I may say, in your global balance strategy, you've had an exceptional year. I know everyone's a long-term investor, but particularly the Global Balance Fund has seen the benefit of some of those strategies, certainly in the year that is 2025 today.
Yeah, can I just thank you for that? But I just can't say they won't all be like this. Please do not extrapolate from the last 12 months or so. It's very important to recognize that our performance never comes in a straight line. So we remain very.
We understand that we have also lived through some lean years of the same strategy.
It's nice to be able to repay your loyalty. Thank you, Craig.
All good. So to wrap up, Ray, Dan, thank you so much. You've given us a lot to think about in a world where the rules change daily. We all need to be reminded, Ray, you did talk about it, of the requirement to remain focused, not to panic, take a long-term view, and to trust the process. And this is what top achievers in life do, in sport, and investing is no different. And again, Ray, you spoke about it, but a simple example is the recent dramatic sell-off we saw in April this year. Markets rebounded very quickly. I think there's a one-day return of the S&P 500 of 10%, I think, which is an all-time record. And fearful sellers would have lost out materially. So our investors seek long-term real returns, not daily trading profits. So it's very important for us always to remember this. That's not to say that at the time we were speaking about the need to to remain disciplined and the market was down 20%, that it could have fallen another 10%, it could have fallen another 15%. So, you know, we see those declines and drawdowns from time to time, but the message remains the same. So yeah, thank you to everyone for joining us. Again, thank you to both of you, Ray and Dan, for your very, very valuable input. And for all of those on the call, we have made a recording of the webinar and we'll be sharing it with you in due course. So we thank you all for your time and wish you a very pleasant day further. Thank you.
Thank you very much.
Thank you very much.